Hello again, everyone. This is Ryan Hansen with Insurance Designers of America. Thanks for taking a few minutes out of your day to join us. Insurance Designers is a group of independently owned insurance agencies who partner together to deliver more value to you, their producers. And I'm really excited to have our presenters with us today, Dorota Meller, Trista Dolce, and Charles Perrault from Prudential. Before I turn it over to our Prudential friends, one quick housekeeping note. Attendee phone lines are going to remain muted throughout today's call to minimize distractions. If you have a question, though, we still want to hear it. To share that question with us, you can use the control panel on the right-hand side of your screen to raise your hand, and I can unmute your line at the end of the call where you can verbally ask your question of our presenters, or you can type your question into the chat box, and I'll read your question to our presenters at the end of today's call. So with that said, it's my pleasure to turn it over to Dorota Meller with Prudential.
Thank you so much, Ryan, and thank you for all of you for tuning in today. Like Ryan said, my name is Dorota Meller, and I'm a marketing manager here at Prudential. I work very closely with Ryan at IDA. And so today's webinar is the first of a three-part series titled Big Case Hunter. And we're going to first kick it off with a webinar to cover loan rescue. And to cover this, we have Chuck Perrault here on the phone with us as a presenter, and he's a director at with Advanced Markets at Prudential's Individual Solutions Group. He's really the guru of loan rescue. I've heard somebody say when they were presenting him that if Chuck can't figure it out, then it can't be done. And additionally, he also consults on advanced market strategies, everything including estate, business, charitable, wealth transfer, and retirement planning. He's also a frequent speaker on all of these topics. He speaks all across the country. And so I'm really excited for him to be on the phone today. Thank you so much for your time, Chuck. And with that, I'll turn it over to Charles.
Good morning, everyone, and I guess good afternoon if you're on the East Coast like I am. And thanks for taking some time out of your day to hear about this sales idea. As a little bit of background, this has been probably the single most successful sales idea that we are out there talking about and promoting. It's generating tons and tons of activity, tons of casework, and ultimately at the end of the day, and importantly for all of you guys, quite a bit of paid cases. We're actually more than double the amount of paid business that we were last year, and we still have certainly the best part of the year left. So this is really a banner year for this strategy for us. We're going to go through three things here today. The first one I call a historical perspective. So why are there so many policies with loans and what are the issues? That's what we're going to talk about there. The second thing we're going to do is go through two case studies. So we're going to start with going through one really easy case study, and then we're going to go through one really difficult case study. The last thing we're going to go through is what I'll call the Prudential advantage. So why Prudential? Why are we so good at this? Why are we getting so much of this business? I'd ask that if you have any questions, you type them in the chat. We'll try and take those at the end if anything is unclear. So I want to start with this section that we're going to call the historical perspective. And I always like to start with this slide because I think it's important context. When I do this presentation in front of a group of people, I typically will start with asking two questions. The first question I always ask is, how many of you have ever come across a policy with a loan on it? And inevitably, everybody's hand goes up, right? If you've been doing this for any length of time, their hand goes up. And I always follow that up because everybody's now got their hand up. And I tell everybody to keep their hand up if they're really comfortable knowing what they can and can't do with their clients' loan policies. And inevitably, if not every single hand goes down, the overwhelming majority of them do. No matter how experienced the group is, no matter how much business they've done, inevitably everybody puts their hand down when they ask if they really understand these policies. And that's a big issue because there are a lot of them out there. But why are there so many of them out there, right? Where are all these loans coming from? There's two ways a loan can end up on a policy. And this may seem pretty obvious, but it's going to help set the stage for the rest of our conversation. The first way that a loan can be on a policy is simply the client needs money and takes the loan from the contract, right? When we sell them these contracts and they have cash value, that's one of the things we tell them they can do, right? If you ever need a bunch of money because you have an emergency, this policy's cash value is here for you. I would say they're equally likely to do that no matter what kind of contract they were sold, right? Universal life, whole life, whatever. If they need money, they're going to take it and they're not going to care what the type of contract is. They're going to care that they have money they can take. But the second way a loan ends up on a contract is unique to whole life. On whole life contracts, if you don't pay your premium, that premium is going to automatically be loaned out of the contract for most old contracts. And the way the net effect of that is over time, we can end up with some real issues. And if you're not in an environment where a lot of whole life is being sold, we deal with this a lot with our advisors here at Prudential because we don't sell whole life. We haven't sold it for a number of years. You might not realize how much of it is actually out there. And we have this slide which shows, as of 2016, I don't have last year's numbers yet, but whole life was almost 40% of all of the sales in this industry. And even if we look back in the early 2000s where it had gone down, it was still somewhere around a quarter of the sales. And if we extended this graph even farther to the earlier years, you would see that number go up pretty dramatically because if we go far enough back on this timeline, really the only permanent product that was sold anywhere would be whole life. So if we go far enough back, this would get up to 100%. Here's the issue. No matter what company you picked, the illustrated rate that we showed from the dividend rate far underperformed whatever the contract had projected. You can see even the lowest dividend yield in 1990 is far higher than the highest dividend yield today. And while we don't call out the carrier specifically on here, these are all really the major carriers that you're likely to run across. And again, you could make some of the same criticisms of universal life as not performed as well, but this automatic loaning feature is really unique to whole life. And if we consider how many of these policies were sold, a typical sale 20, 30 years ago, and to some extent even still today, is, I know it shows you paying your premium forever, but if you pay like 10 or 15 of them, then this policy should take care of itself, right? That's how a lot of these clients were sold many of these contracts, certainly years ago. And two things happened, right? We can see from this screen that the policies underperform, right? No matter which company you pick, the policy just didn't do quite as well as you were expecting. And the clients often didn't do their part either, right? The clients, if we told them to pay 10 or 15 times, they oftentimes paid 8 or 4, or certainly in many cases didn't pay all of them. And even if they did pay all of them, because the contract didn't perform as well as we would have hoped, the net effect of that is that there would be loans on the contract to pay their premiums when the dividend hadn't accrued to what they expected. And here's the issue. When they don't pay their premium and those loans start on the policy, they might start off as a series of relatively small loans. In fact, they probably do. But many of these older contracts have very high loan interest rates. It's very uncommon to see a loan interest rate less than 6% on an older contract. It's not that uncommon to see a 7 or an 8%. There are certain companies that are pretty much always 8% when I see their old contracts. So what may have started off as a series of relatively small loans over a number of years, and many of those happening, accruing at a relatively high loan interest rate, really drag these contracts down. And they can get to a point where the loans are causing sufficient damage to the policy that they're ultimately going to make it lapse. Alternatively, we've also seen a number of scenarios where perhaps a client took this policy out when they were 30 or 40 and had a family and a spouse and children, and they're now in their 60s or 70s, and they say, hey, you know what? I see that there's this loan on this contract, but I don't really need it anymore, right? We got through all my working years. I don't necessarily care about this coverage. So I'm going to surrender this contract and I'm going to take the value and perhaps go buy a boat or go do something that they didn't want to use their more dedicated retirement funds for. In either case, whether the policy lapses just under the weight of the loan or if the client chooses to surrender it, that causes this thing that we call phantom income. And what that means is all that debt that was against that contract gets considered forgiven debt. And the way the IRS looks at that is all taxable to the extent of the gain in the contract. And for many of these clients, that gain is substantial. Most of the cases I look at, we're talking tens of thousands of dollars of gain. And I certainly see a number of cases where it's hundreds of thousands or even millions of dollars of taxable gain. So these clients don't really realize what they're doing, but when they either let their contract lapse or choose to surrender it, because while they might get that surrender value, well, they would get that surrender value, they're also going to get a big 1099 that in many of their cases the taxes owed would actually far exceed the value they would get from that contract. So you'll see this slide a couple times in our presentation. So whenever we get people with loans on their policies, I try and say, well, really, you have three options. The first option is you can do nothing, right? You can do nothing and let it play out and let your policy stay in force as long as it will. If the policy is not that loaned out, then that might be an appealing option. When we get to these cases where the loan is a really high percentage of the value, though, that's not a particularly appealing option because it's going to cause your policy to lapse, which will ultimately cause that tax. You can try and pay off the loan without out-of-pocket funds, or I'll call this one the fix your current policy option. And that, again, might make sense, particularly if your underwriting isn't particularly good anymore. It may make a lot of sense to fix your old contract. But some of the problems we have there are really twofold. The interest rates are usually really high, and a lot of these older contracts are not particularly flexible, right? You can't change a whole lot. You can't do, for instance, a death benefit reduction in many cases like you might be able to do today. So the options to fix their policy are a little bit more limited than what we might have with option 3, which is to move it over to a new policy and try and fix the loan over here. And the way I always describe this is your old policy never anticipated having a loan against it. It was never part of the design. It was never illustrated at the beginning. It has a really high loan interest rate. And by the way, your policy has also underperformed. So it's hard to imagine that if we can't design a contract today and restructure it and take the loan into account and have the sole purpose of our design be to deal with their loan as efficiently as possible, it would be hard to imagine that we don't have at least a pretty good chance of doing a better job at helping solve their problem than this old contract where they never even considered this problem in the design. So this is a bit of the background of why there's so many of these loans and what the problem is. I want to go next to 2 case studies. We're going to go through one really easy case study first, and then we're going to go through one particularly challenging case study. So these are both real cases that we did. The first case is actually a gentleman who was a financial advisor. So he had sold himself his contract earlier on in his career when he started to do well, as you'll see. And he got to a point that maybe some of you can appreciate if you've been around that long. In 2008, he wasn't having quite the year that he had been having prior. He wasn't making the money that he was making because he just wasn't getting those managed money fees because the account values were so much lower. So when he wasn't making the income, he wanted to be in a spot where he could not spend as much money. And an easy thing for him to not spend money on was his life insurance premium. And as many of you can probably relate, once a client stops paying their premium, they tend not to start paying it again, right? If you stop, the likelihood that you go back and start is generally pretty low in my experience. So what started as a series of relatively small loans is now a pretty decent number, and we'll get to that in a minute. So he came to us and said, well, what he'd like to do is a couple things. He'd like to design something where he doesn't have to pay any more premium. He'd like to ideally maintain the death benefit that he had, if that's possible. And if we can help him manage this loan, that'd be great too. So we said, all right, let's consider what this means for your 3 options. The first thing you could do is do nothing. All right, well, if he did nothing, that loan that he has on his contract is just going to keep growing. And again, for this particular guy, it wouldn't lapse the contract, but it would keep growing. And at 8% interest, which it was, it ends up being a really, really large number down the road, and he wasn't comfortable with it. The second thing he could have done is try and fix the loan on his old contract by putting some money towards it. But again, he didn't want to spend any money, so that option didn't make any sense. So option 3 was move it to the new Prudential contract. So this is what this gentleman had. He had $1,125,000 in his contract, and he had $240,000 that was already loaned out. So that would leave him with something like $885,000 of surrender value. So this contract is objectively not in that bad of shape, right? Only about 20% of the value is loaned out. But if you consider how big this loan grows at an 8% loan interest rate, $240,000 at 8% for a 50-year-old is something like $4 million by the time he gets into his 80s, if my quick math serves me right here. So it ends up being a really big number, even if it doesn't necessarily lapse the contract. So what we did is we moved it over, and if you're familiar with our products, we moved it over to a Prudential Founders Plus. It's our current assumption death benefit oriented product. That's the contract we tend to use for most of these sales. What we were able to do is a couple things. First of all, we were able to increase his death benefit pretty substantially. We increased it from just under 3.9 million to a little over 4.75. So that's almost a 25% death benefit increase. The other thing we were able to do is maintain him not paying any more premiums going forward. But the real magic of what we were able to do is what you'll see down here in the text. If you read that second bullet, it says, in this specific case, the loan was able to be repaid entirely by withdrawing a portion of the cost basis in the second year and using those funds as a loan repayment. So in year 2, we simply went in and took a big withdrawal, and it was a return of his cost basis, so there wasn't any taxes owed, and we turned around and used that money to repay the loan. And what we ended up doing after everything that happened here is he got a lot bigger death benefit than he had. He never has to pay any other premiums again. And this loan that, by the way, he didn't really feel like he took, because the only reason it's there is because he didn't pay his premium. So he doesn't certainly feel great about it. He doesn't feel like he took it and went and bought a lake house, for example. So this loan that he doesn't feel like he took, he's able to get rid of them by simply using the contract's own values and redirecting it to repay the loan. And this is a strategy that we use all the time. Essentially, anytime the loan is less than about half the value, this is what is requested of us and what we try and go in and do. And to the extent that they have the cost basis to be able to do so, and many of them, I would say even most of them do when the loan is this percentage of the value, we are able to do this. Because the appeal to the clients is pretty obvious, right? I can get rid of this loan, I don't spend any money to do so, and as long as you can maintain my death benefit, forget increase it, that's probably going to be an option that makes a lot of sense. And for any of you who've looked at replacing a whole life with a UL contract, typically we can also increase their death benefit in doing so, because whole life tends to be a little more cash rich relative to the death benefit. So this is what we tend to do on any of the easy cases, right? Bring everything over, take the withdrawal to get rid of the loan if we can, and ultimately design something to give them a big old death benefit. Typically, they don't want to pay anything, but certainly if they were looking to pay for some premium in and to obtain more death benefit, I promise you I'll find a way to design the illustration to accept their premium. We're more than happy to take their checks. So this was the easy case. I want to go next to the hard case. So this was a gentleman that came to us, and they had come to us through an office that went to a bunch of different carriers, because this was a couple of years ago before we were really known for doing this. And every other carrier told them there was nothing they could do with this case. You'll see why in just a minute. This particular guy had done everything wrong. He took out his policy when his business was doing a little bit better. Today, his business was not doing that well. So he both stopped paying his premiums and also took additional loans out of the contract, right? So he did everything wrong. And that left us in a situation where he is today, where he has $300,000 in his contract and $299,000 of it was loaned out. It was so loaned out that this gentleman actually had to put money in his contract to keep it in force long enough for us to underwrite him, because his contract would have lapsed. And so many of you have seen a client that looks like this, right? You haven't seen this exact example, but you've come across a client that's in such bad shape that it doesn't seem like there's a lot of good options. And I'm not here to tell you that we can take a loan that's $299,000 out of $300,000. Nobody can. That's far too loaned out to work with any carrier. And his current contract is definitely going to lapse if he doesn't do anything. But I am here to tell you the story of how we were ultimately able to turn this into a sale and a pretty good case for both the advisor and a much better situation for the client than what they were looking at. So we said, what are the issues that this guy has? Well, first of all, he doesn't have enough cash value to meet our minimum requirements. I'll get into what those are in the third section. The second thing is the loan is too big to create positive surrender value. And when you bring over a loan, you have to have a positive surrender value, because you can't have a negative account value with a loan. So what we had him do was have the client pay back some of the loan prior to the exchange. And that may seem like an obvious example, but I think the way that we lay it out is really what makes the sale here. So you'll see this is the same three options that you've seen several other times in this presentation. So we said, Mr. Client, your first option is to do nothing. Your contract's definitely going to lapse. And if it lapses, he was going to get a 1099 for $240,000, all as ordinary income. I don't know exactly what he would have owed out of pocket, but we can pretty safely say somewhere between $90,000 and $100,000 to pay the taxes that would be owed on $240,000 of ordinary income. So option one is you basically write the IRS a check for $100,000. You don't have any more life insurance. That's not a particularly appealing option one, right? Most of your clients probably aren't going to pick that one. And if we tell our clients that's the option, they're going to immediately ask, what is literally any other option than that? Because that option is terrible. So the second option is to try and keep that old policy in force. To do that, they'd have to pay two numbers because it's an old whole life contract. He'd have to pay the premium, and he'd also have to pay all of the loan interest. He had been accruing both of those against the policy's values, but there's nothing left to accrue against with the way it was. He was also the proud owner of one of these 8% loan interest contracts, so just the interest every year was $24,000. And with the premium, it was about $30,000 a year to keep that old contract in force. So is that better than giving the IRS $100,000 to pay your taxes? I ask this a lot in front of groups, and I usually get both answers. Some people will say, well, yes, this is better because at least they're getting something for their money. But this guy's 54 years old, and we're showing him paying $30,000 a year for a long time. $30,000 a year adds up to $100,000 real quick. So while this actually gets him something, it ends up costing him far, far, far more money than what he would have paid in taxes. So option three was the new Prudential contract. So let's go into how we did that. The first thing we did was we needed this client to pay the loan down to a number where we could deal with it. We can't take a loan that's $299 out of $300, but we can take a loan that's $260 out of $300. So we asked the client to write a check for $39,000 to pay down the loan on the old contract to get it to a point where we could deal with it. We then needed to put, so what we did then is we had him write that check, we moved it over to the Prudential contract. We then asked the client to pay the interest for 5 years. The interest was $10,400 a year. So all in, the client spends $91,000 over the next 6 years, and that actually gave us a policy that is healthy enough to run forever at current assumptions. So we spend less than he would have spent in taxes over a longer period of time, and far less over the next 6 years than his old contract would have required. And while we can stop that client from having this policy lapse, what we don't do is get rid of the loan, right? The loan is still going to sit on our contract. It's still going to pull that death benefit down as that loan interest accrues. But what we found with many of these cases is the clients don't really care about the death benefit. It is simply about spending as little money as they can to not have this taxable event. And when these policies get to be 60, 70, 80, 90, 100% loaned out, there really isn't an awesome option to get rid of that loan. The goal shifts from getting rid of it, like we can on a 10 or a 20% loaned out contract, to let's just show them something that they can be comfortable will stay in force long enough for them to die with it. Because if they die with it, the loan will get repaid out of the death benefit. So for many of these highly loaned policies, it's more of a tax avoidance sale than a death benefit sale. Certainly getting a couple $100,000 of death benefit like this guy probably will, it's still pretty meaningful to his family, but it was really more of a secondary consideration. It was just about spending the least amount of money. So there's a lot going on here, right? He had to pay down the old contract, he had to move it over, he had to pay interest on our contract, but ultimately it becomes pretty much a math equation for the client, right? Here's the cost to pay the taxes, here's the cost to fix my old policy, and here's the cost to fix a new policy. And for the most part, they got into this situation by spending as little money as they can. They're going to want to get out of it the same way. And ultimately, that's an option that we can prove to be successful in very often. So let's go into our last part, right? The prudential requirements and advantage. We have one hard rule. The one hard rule is you have to have at least $25,000 of surrender value. Now, I say at least $25,000 of surrender value because in some cases you will need more. $25,000 is the minimum amount that we need to have left over after the loan for us to bring it over. Some cases I deal with, there's millions of dollars loaned out, right? If we have $1 million in the contract and they only have $25,000 left, that's not particularly meaningful, right? It's a relatively small percentage. So $25,000 is the minimum, and about the highest percentage loaned out contract we can take is somewhere between 85 and 90% loaned out, depending on the client. We can help you guys figure that number out if you have a real person and you're trying to determine that. But somewhere between 85 and 90% loaned out, above that, it'll just stop working. But hopefully with that last case, you saw how we can actually position them to pay the loan down to get it to a point where we can deal with it. Every case does require a corporate exception, so you may get some questions on that if you submit a case with us. But all that exception is there to do is to make sure that we don't get in a situation where if the values are just a little bit different, that this doesn't work. It's not a suitability exception, it's not a compliance exception, but every now and then we'll have somebody working off of numbers that are a year or two old, and if the loan was a little higher and the surrender value was a little bit less, then this wouldn't work. The exception process is just a check on our end to make sure that we don't get in that situation where we cause an issue. If you work with us, we will get you that every time because we know what the rules are. We'll design the contract within those rules. The other question I get a lot is, does it require underwriting? We're buying a new product, so it's fully underwritten just like any new Prudential contract. Certainly, it's really helpful if they're preferred best. That being said, we've also done our fair share of cases where they're rated, especially on these more highly loaned ones, because when the sale becomes less about the death benefit and more about just keeping something in force to avoid taxes, the rating is still relevant, but not quite as important as when they're trying to buy lots and lots and lots of death benefit. The biggest advantage that I think we can bring to the table for you, though, is how much of these cases that we see. I've worked on something like 75 new cases already this month, and we're not even a third of the way through the month. A typical month for just myself, forgetting the other people on my team and what they do, is looking at several hundred new cases. If we had them in, we're probably closer to 300 or 400 new cases that we look at every single month. And as hopefully many of you can appreciate, the more you do something, the better you're going to be at it. We do a lot of these cases. We have hundreds of applications that will pay for us this year. So there is nothing that I can't tell you the last time I came across something new, because we just see so many of them. We've really seen it all. So while for many of you guys, maybe even all of you guys, the next time you do one of these mirrored loan cases, it will be the first time you do it. It certainly isn't the first time for us. We don't expect you to figure out how to design these and all of that. You just give us some idea of what you're trying to do, and we'll either do it exactly or at least show you an alternative and show you what we can do for this client and explain to you, what the challenges are so that you understand it and are as prepared as you possibly can be to get out there and actually make that presentation. Because if you're not comfortable with it, your client's probably not going to be comfortable with it either. So that expertise and that background that we have, I think, is probably the single most important asset that we can offer to any of you. All of our products are available. So we don't have any specific product restrictions. As you might expect, some products will work better than others. For any of you who are familiar, most of the time we'll go to Founders Plus. But again, if you really want to sell them a different product, they're all on the table. The GUL, full guarantee, no cash value products tend to not work particularly well. We really need something with cash value. But if they're willing to write a big enough check, I promise you I can make anything work. And again, the last part, just worth repeating, there's no strict loan to value limitation. There's just a number beyond which it won't work, which is somewhere around 90% loaned out. So we went through three things, right? We went through the historical perspective, we did the one easy case study, and then the one particularly difficult case study. And then I went through the why Prudential portion of this. So what's in it for all of you guys? What's in it for all of you is a couple things. First of all, you're going to help these clients retain the coverage that they need and want in many cases. We're saving them from these policy lapse and ultimately these really large tax consequences that many of them would face and probably aren't aware of. But the last thing is arguably the most important, which is what we've seen through having these conversations with folks, is it tends to be a much more comprehensive conversation than the first time they bought their policy. Because you get into tax planning, there's often an attorney or a CPA involved in this with some of the larger cases. And oftentimes we're simply uncovering other policies that the client had that they were reluctant to talk about it with prior to trying to work through this. So we're just having better conversations, and ultimately that usually turns into bigger cases. So my call to action is what I ask all of you guys is this, and then we'll wrap up and take some questions. This is my favorite idea because for many of you, you already have these clients. Perhaps you sold them the policy or became the agent at some point, but you have these clients in your books of business. And maybe before this call, you didn't think there was a great alternative or anything much you could do in that. So take a look at those folks you've already met with and see if some of them hit that $25,000 minimum. And when you identify those folks, work with our partners here at IDA, work with them to get those proposals over to us. We'll help put something together for you guys, and we'll make sure that you are comfortable getting out there and having these conversations. Right? If you get us the numbers and you give us a good idea of what the client is trying to do, we will be able to generate a proposal for you that hopefully you can get out there and not only help some clients, but generate some business and make some money off of. So Ryan, that's what I had for the formal part of this presentation. Do we get any questions in the chat that I can help answer? Or if you guys have any questions, now would be a good time to put them in the chat.
That was great info, Chuck. Really appreciate you sharing that with us. I thought your anecdote at the outset where you shared that everyone sees these cases and far fewer people know what to do with them was spot on. So appreciate that. We do have a few questions queued up here for you. The first one is, why wouldn't you repay the loan first and then move the money over? I know it's tough to answer a general question when the specifics vary case by case, but any thoughts on that?
Yeah, so that's actually probably the single most common question that I get. The answer is you might do that, especially if you were planning on keeping the policy where it is. If they had the availability of value in the contract to do that, it could make sense. Sometimes they don't, though. Sometimes they have enough cash, but not the right kind of cash. Whole life contracts have two kinds of cash, and the guaranteed cash value you can only loan against. So you might have enough, but it might not be the kind that you can withdraw. The other scenario is if you plan to 1035 it anyway, perhaps because you're getting more death benefit or you're getting a chronic illness rider or something that your other contract doesn't have. If that's the case and you're planning to do it anyway, then if you don't want to take a withdrawal before the 1035 because the IRS can actually look at that as a step transaction and make that withdrawal taxable. So those are the two reasons. But there's definitely times where you would do that.
Awesome. Great. Next question here is, do you have a fact finder that we might be able to share with call attendees that they could use to begin collecting the information necessary for you and your team to work their magic?
Yeah, we have a spreadsheet that we ask folks to fill out with all the values that we need. So Ryan, I can get that over to you after this if you'd like to distribute it.
That would be great. Really appreciate it, Chuck. Have at least one more question for you. Just a reminder, if you do have questions for our presenters, I encourage you to type those into the chat box, and we'll do our best to get those answered. This next question, Chuck, is what are the consequences of a 1035 exchange/mirror loan where the loan exceeds the basis? Is that scenario viable?
So if you bring the loan over to the new contract, which is what we're doing in all of these, that's a tax-free 1035 exchange, just like any other 1035 you guys have ever done. If you don't bring the loan as part of the exchange, that's where you're going to get taxed to the extent that there's any gain in the contract. So if you're bringing it over, it's not an issue.
Awesome. Quick note here to my friend Joe Z. If you could type your question in, I see you have your hand raised, but if you could type your question in, I think that's just going to go much better. I see you're using computer audio, and in my experience, that often doesn't work right. Next question here for you, Chuck, is this is an IUL policy, right? If so, after rescuing a policy, if loans are potential in the future, then the policy becomes the only source for the loan, correct? No banks will loan against the cash value on an IUL policy, right?
So,
if you need me to read that one back,
yeah,
I know there's a few parts
I see
to
what
it.
they're asking, right? I see what they're asking. So banks will often issue loans against a whole life contract and using the policy as collateral. I can't speak to what they would do with the IUL. I don't know it from their perspective. My hunch is that that's probably correct, but the policy values would be available to them if they needed it through a withdrawal or I guess through another loan, but we would probably want to avoid that. But there usually is meaningful surrender value available to them if they really wanted it. So that point might be correct in terms of it's exactly right, but not necessarily in the essence of the policy values are still available to them. So they can still get at that money.
All right, great. This next question I got in here for you, Chuck, it sounds like it's a specific case. I can read the specifics to you, but would it be safe to assume that you probably can't, speak to it too much until you, get in front of your, case design software and stuff like that? I don't want to assume, but I also don't want to go through and share a bunch of case specifics that you may not be able to act on. I'd be happy to connect you with the person that's asking the question. Does that sound like a good plan?
Yeah, I think that's probably the way to go. Rather than go through all the details with somebody. But I would say if you're ever in doubt, send us the numbers and let us tell you that you can or can't do it. I would start with the assumption that we can probably do something with most cases. And then if we find out that we can't, we'll get there pretty quickly. But most of the time we should find out that there's at least some conversation to be had.
Awesome. Any other final thoughts, Chuck, before I turn it over to our friend Trish DeGolce for some closing comments?
No, that's everything I had. I appreciate all the questions, guys.
Well, we appreciate all the great info. Trish?
Thank you very much. I want to thank all of you very much for attending today's call and for hanging in there. I apologize, we went a little over, but Chuck always brings such wonderful and valuable information. He's a great resource. He can be available to you. Just go to your IDA general agent, ask him to bring you in touch with Chuck Pearl, and he'll do that. Ryan, thank you again, always, you and Insurance Designers, for your partnership and your genius. We really appreciate you and Dorota setting up this series for us. And again, we thank everybody for all that you do. Have a wonderful day. And again, thanks for being here.
Thanks, Trish. Thanks, everyone, and take care.